Hello, everyone. Welcome to our quarterly trust administration workshop, what was seminar, now webinar. We're very happy to have you here. And we will be going through a number of topics. We would like to thank first our sponsor for today, and that is TRUSTCO Bank. TRUSTCO has been sponsoring our quarterly trust administration workshops now for a couple of years, and we're very happy to have them as part of the program. Michael Bates will be with us today, and John Berzanis, and we'll be looking forward to hearing from them with regard to the role of a corporate trustee and how corporate fiduciaries play into the trust world. And our agenda for today, we're going to cover a lot of topics. We have 90 minutes, so we're going to try to be as thorough as possible without being too boring, Aaron. So we're going to try to keep it lively. And trusts, by definition, are contracts. We'll talk about that. Trust planning basics, how to fund your trust, making sure that all the assets are properly titled, how to administer a trust during the lifetime of the grantor. And we have a special guest with us, David Wojcicki, who has been with us many times before at our quarterly workshops, and he's going to cover the income tax aspects of trusts.
Hello, Aaron.
You have to file. And there's David now.
How are you guys?
And we're also going to talk about trust administrations at death and how a trust then transitions into the next generations and on to spouses and on to other beneficiaries. So that's the flow of the topics today. And to get started, we'd like to take a brief poll. So if you get your mouse clicks ready, and what interests you about trust administration? We're trying to obviously get a feel for who we have in our audience today. Very happy to have you all with us. But are you here because you have a trust and you want to learn more about it? That you are thinking about creating a trust? That your parents or some other family member may benefit from a trust? Or are you a professional who is lurking out there in the weeds? No, a professional who is joining us today to see how we cover the topic. We'd like to know who you are, so if you would click on the appropriate response. And if you do have a trust, if you're someone who already has a trust, if you would let us know, are you the grantor, the trustee, both, or a beneficiary of the trust? And if you're not sure, we can certainly help. And hopefully by the end of the hour and a half, you'll have a good idea on what role you're going to be playing with regard to that trust. So as we can see, most of you have trusts. There's our responses. 64% have trusts, 38% are professionals. Some of you are thinking about creating a trust. Some of you are hopefully benefiting from a trust, or maybe another loved one. And then with regard to the roles in the trust, half of you are trustees, which is great. We're going to talk all about your fiduciary duties today. Beneficiaries, and for the 21% who are questioning, who are not sure, we'll cover that as well. So thanks for responding. And with that, we're going to get on with the show. There are many different types of trusts. You'll hear living trust described very often, but living trusts, that term describes a whole variety of different types of trusts, and it simply means that the trust was created during your lifetime. Testamentary trusts, as opposed to that, are created upon the death of the individual creator of the trust. Very often in a will. Sometimes we refer to testamentary trusts that are even created in trust documents that don't take effect until death. A trust, if it's a living trust, can either be revocable, meaning unilaterally you can put assets in, take assets out, break the trust without anyone's consent, or irrevocable, meaning that once the assets go in, they're in there and you cannot break the trust, although we're going to talk about some ways that we can build flexibility in and you can keep control over even an irrevocable trust. Why would you create revocable and irrevocable? We'll talk about that, but some of the reasons are tax motivated. We use life insurance very often in estate planning. If you want to have life insurance not be part of your taxable estate, we use trusts for that purpose. We use trusts to take advantage of retirement plan benefits and make them payable to trusts. You have a child with special needs or a loved one with special needs, or you have special needs, A trust that will protect your government benefits, Medicaid and SSI, can be established, and that's called a supplemental or special needs trust. We get very fancy and go to Delaware, Nevada, Alaska, other states that allow trusts to be done in perpetuity, and we call them dynasty trusts. They last generation over generation. We'll talk about why we do those types of trusts in a moment. Very, very prevalent today is the desire to protect assets, and that's from a variety of different creditors. Medicaid is one of the most common. Divorcing spouses, liabilities, lawsuits. If you have an occupation that puts you at risk of litigation, there are ways to create trusts for asset protection purposes. And one of the most, I think, beneficial ways to create a trust is to create the trust for someone else. And for example, in my living trust, my beneficiaries, my wife, and then my children. When it goes to my children, it doesn't just go to my children. They each receive a trust that they will control, but it would be protected. And we'll talk about those trusts and how we can set up next generations. Once you create your trust, and most of the time when you hear a seminar, it's all about, that's good, but knowing how a trust works is better. And so today we're going to concentrate and focus on how the nuts and bolts all fit together, how you build the trust, and what provisions go into the trust, so that for those of you, the 50% that are actually acting trustees, what's inside that trust that you need to be aware of? How do you follow the terms of the trust? How do you fulfill your duties to the grantor and to the beneficiaries, and make sure that you're performing the duties of the trustee appropriately? So we're going to talk about the contract, the agreement, where a grantor hands off to the trustee. Trustee manages assets for the benefit of a variety of different types of beneficiaries. Lifetime management in a trust is an excellent way to manage assets. So we put all the assets in a basket, and the trustee has access, control, and can manage all of those together. You can avoid probate. We're going to talk a little bit more about that towards the end of the program. And we can make sure that you have privacy, protect assets, reduce taxes. And all of these are some of the things that we're going to talk about and how the trust functions to accomplish the goals of the grantor. There is no one-size-fits-all trust. Every trust is different based upon what the wishes, desires, and assets of the grantor are. So when we're designing trusts, we take great pains to make sure that the intent is known and that the document is prepared to carry out that intent. And it is the trustee's job. They have a fiduciary duty to carry out that intent of the original grantor. So with that, a quick poll. The most common reason that a trust fails is it was improperly drafted. Did you use LegalZoom? Did you go to an attorney? The trustee steals the money. We've heard about some attorneys recently that have been in that role. Not common, thank God, for attorneys, but trustees, they're put in a great position of control. Is it that they steal the money, that assets were not properly transferred into the trust, or that the tax returns were not properly filed? What's the most common reason that a trust fails? Give you a few more seconds. Okay, pencils down. Most of you are on target. 65% said that the trust was not properly funded. Aaron, we see this all the time in our office. Trusts come in, they've been done in other places, they go online, however they got the trust done. Their assets are over here titled in their own name or in husband and wife joint names, and the trusts are over here. And unless those assets get titled properly in the name of the trust doesn't work. It doesn't own the assets. Nothing the trustee does can control the assets unless they're titled in the name of the trust. Certainly we see drafting errors. Most times we can fix those. And we also see trustees that do go off the rails, but fortunately, again, it's not that common. And if you hire Dave Wojcicki, you're never going to have the wrong tax returns. So we know that that's not a problem for Dave's clients. And usually the tax returns may or may not be filed, but the trust doesn't fail. It fails primarily because the assets don't make it in.
I can just say briefly that we have a case in the office now that really suffers from two of those things. The attorney drafted a trust but no will, and the trust beneficiaries are not kin, and certain items never made it into the trust. So it was not properly funded. And the fact that there was no will done means that people are going to get things that shouldn't have got things.
So what happens, Aaron, when you have a trust, no will? That's hard to believe.
Yes.
But a trust with no will and assets going to people in the trust that are non-relatives, what happens to the other assets?
The other assets are going to go either to children, which there aren't in this case, then back to parents or to siblings. So seems like this person made a conscious choice that they did not want their family to get certain things, but unfortunately, because the attorney omitted doing a will when doing a revocable trust, that's going to happen.
And it's pretty common that clients come in and ask, do I need a will? I have a trust. Why do I need a will? And the answer is?
Because if you don't fund your trust completely, you need ways to get things to your trust. And usually it's a pour over will, meaning that if it's in your estate, it goes over into your trust at that point in time.
And even if you fund your trust perfectly at the time the trust is created, you may buy a car after, you may buy a home after, you may get a tax refund check after death. Things happen, insurance claim checks come after death. We've had that in several estates. Those are probate assets. Anything that is not titled in the name of your trust or designated with an appropriate beneficiary becomes a probate asset. Then you're in court. Now you have unintended consequences, and we want to avoid those at all costs. So when we talk about funding your trust, we want to make sure they're carefully drafted, but then we want to also look at what it is that you're going to put into the trust. So we've given you a whole set of materials, and if you're a client of ours, you've got most of these already. We do have some new documents that we've put into the arsenal, and we'll talk about those, but your planning documents is the first handout, and what this does is lists out all of the documents: healthcare proxy, power of attorney, disposition of remains appointment, trust, will. So you have a comprehensive list of all the documents that you're utilizing. We then provide you with a trust funding letter that talks about how each asset class goes into the trust: stocks and bonds, life insurance. How do you deal with retirement accounts? How do you deal with real estate, business interests? All of those are discussed in the funding letter. Your kit, your trust funding kit, includes a certification of trust, which you give to a financial institution. You get an attorney certified copy of your trust, and then we give you a trust funding worksheet. And that's the document that you prepare as you transfer all of your assets into the trust and then send back to us. Because what we like to do is hold your trust hostage. We don't give it back to you, the original trust, when you sign it. We give it back to you once it's fully funded. And we will pepper you with letters every 30 days to see if you funded your trust and make sure that you do the things that need to be done, because this is so critical. Funding your trust is absolutely essential to making it work for you. So that trust funding worksheet comes back to us. We prepare Schedule A to the trust and then send it back. So funding is critical. Let's talk about the different types of trusts and what assets go into the trust and what assets maybe stay out. Revocable trusts, I mentioned earlier, two main functions of the revocable trust. It provides comprehensive asset management during lifetime. Well, you may say, I can manage my assets. Why do I need a trust? What if you become incapacitated? What if you have an accident, an illness, something that renders you unable to manage your financial affairs, to manage all of your assets? This is in particular important for people who have business interests and other assets that require active management. You will have a trust. You will be the trustee in a revocable trust yourself. So you're wearing the hat of the grantor. Your assets go in. You're the trustee. You're managing the assets. You're also the beneficiary. So you've got all three hats in the beginning of a revocable trust. Incapacity is one trigger where your successor trustees will step in. Death is the other. And we want your assets managed for you, protected. Aaron, we see fraud and abuse all the time today. It's becoming almost an epidemic.
Absolutely. Unfortunately, there are a lot of beneficiaries out there who feel like they're entitled to the money early, or they need the money for a certain reason, and it's available to them because they're a power of attorney, trustee, some other agent, or they just kind of wear mom and dad down and they get access to the money. So
Yeah.
that's a big problem.
A lot of kids want an accelerated inheritance. That's not necessarily what's best for mom and dad. So when you have a living trust, you've built your fortress, you've built your terms into that trust that you want carried out. And this is where the trustee comes in. They're a fiduciary. They have an obligation, a duty to manage the trust under the terms created by the original grantor. And again, these are all different depending upon what your preferences are, and that's what we build into the trust. So for a revocable trust, everything that you own that is not buttoned down, that can be transferred to the trust, should be transferred to the trust, because there's no diminution in your control or loss of access to those assets. One major class of assets that do not get retitled during lifetime are retirement accounts, IRAs, 401ks. Those stay in your own individual name. The way that we thread those accounts into your plan is through the beneficiary designation. So although you're not changing ownership of your IRAs and 401ks, you will be changing the beneficiaries to tie your trust together with those accounts. So in an irrevocable trust, it's a little bit different depending upon what the purpose of the trust is. We very often create trusts for asset protection, as I mentioned. So the assets that we want to protect go into the irrevocable trust. We may leave some assets at risk just to have them in our own name and to make sure that we have direct access to those. Annuities can go in, bank accounts go in, virtually any type of asset other than a retirement account can go into the trust. And tangible personal property is a question that a lot of people ask about. Well, I have my grandmother's diamond ring and I want that to go to my granddaughter, or I have my pocket watch that my father gave me, I want that to go to my son. You can list your tangible personal property. We assign those items to your trust, and we will give you a memorandum where you can list the item and the beneficiary. You can keep that on your own and make changes to it as you deem appropriate, but that's a document that lives and breathes, and it's your document. It becomes part of the trust, and in New York, we can integrate that into the trust and incorporate it into the trust, even though it's not inside the trust document. It's a separate document, but that memorandum is something that's in your material, something you can see, and that's what our clients fill out and provide back to us so that we know where they want things to go. Real estate deeds get transferred into the trust, and with regard to business interests, we do the corporate certificates. You want to make sure you own a business, a limited liability company, a corporation, a partnership. You want to make sure you've transferred appropriately all of those interests into the trust. So I mentioned retirement accounts, and I just think it bears noting that we had major legislation that passed back January 1st of 2020 called the Secure Act. And the Secure Act affected a lot of aspects of retirement accounts. One of them is that you don't have to draw now at 70 and a half, kind of an odd age anyway. You don't celebrate your half birthday. Some do, but most don't. So now it's 72. So you don't have to start drawing your traditional retirement accounts until age 72. You can keep contributing now to retirement accounts if you work beyond age 70. That used to be a limitation. But the biggest change in retirement accounts came with the 10-year rule. And so now the Secure Act brought us a rule which says a beneficiary, when they inherit that account, so if my parent leaves me an IRA, I can't take my life expectancy and stretch that IRA out over my life expectancy. This is a big change. Why did the government do this? Pretty obvious, right? They want their money. They were waiting years and years because they're very generous life expectancy tables, and you could stretch it out over your life expectancy. And we were doing planning, leaving it to grandchildren. And when you leave it to a 7-year-old, they've got a 75-year life expectancy. Not a lot of money comes out and gets subject to income taxation. Now it's 10 years. The entire account has to be swept out within 10 years. It could be a lump sum at the end of 10 years. It could be annual distributions. A lot more planning is necessary now for your retirement accounts than was necessary in 2019 and before. So something, if you do have large retirement accounts and you haven't had a look at them in conjunction with your trust, that is something that we'd be happy to sit down with you, talk about it, look at your trust, make sure that the trust is going to be the most effective. You're going to hear Dave Wojcicki talk about trust income tax rates in a bit. So something you need to be very, very careful with. So that's the Secure Act. We did do a video back in January when the law passed which goes through all of the elements. There are some very important exceptions to the rule. So if you have a child with a disability, they can stretch it. Someone with a chronic illness, they can stretch it. A spouse can stretch it. Those are the three main categories. Other than that, you're going to be subject to the 10-year rule. So Aaron, let's dig in a little bit closer to the trust funding issue and look at our different types of trust and what goes in.
Sure. So this is a diagram about a revocable trust. Okay. You see the grantor. Just to be clear, the grantor is the person or persons. So husband and wife, single person establishing the trust. Their assets go in the trust. In a revocable trust, they have full access to principal at any time. So what does that mean? Your bank account's in here. You want to spend $20,000, you can go ahead and do that. No issues. You have a brokerage account in here. It's producing dividends for income. They go directly to you. You want to manage that account in any way, shape, or form, you can do that. You are still in charge of everything. The trust becomes revocable on the death of the grantor or grantor. So if there's two people who've established the trust, it does not become irrevocable, generally speaking, until the second person has passed. At that point, it's distributed pursuant to the terms of the trust. This can be in further trust. It can be outright. It can be done to a charity, which we sometimes do for tax reasons or altruistic reasons, depends on the person. But there is a lot of things that can be done here, and basically you can do almost anything you want in a revocable trust. We're going to contrast that a little bit with an irrevocable trust. Again, you still have a grantor. Okay, that's the person establishing the trust. Here, the trustee is going to be other than you. All right, and other than you or your spouse. It could be a friend. Most times it's children. It could be someone like TRUSTCO as a corporate trustee. Whoever the trustee is going to manage the assets that are in the trust for your benefit. Income is going to come out of an irrevocable trust. Now, this is really interest and dividends. In today's world, there's not a lot of interest. So mostly we're talking dividends from an investment account. And it sits here again until the grantor or grantors have passed and can be distributed again in further trust or outright or to charities, whomever you've chosen in your scheme. Into an irrevocable trust. All right, generally speaking, we're not putting all of your assets down to the last penny you have in an irrevocable trust. This sometimes changes over time depending on how old or how healthy you are when you establish this. The easiest thing to put in an irrevocable trust is your home. It does not affect your right to live there. It does not affect your star exemption. You're still responsible for the maintenance and upkeep and the taxes on the property. But it takes it outside of probate, which is big, protects it from Medicaid once it's been there for 5 years for a nursing home or 2.5 for home care. We'll get into that a little more in a minute. A big thing to note is that your beneficiaries still get a step up in basis because this is a grantor trust. Not to bore you with that, but what you need to know is that if you paid $100,000 for your house and now it's worth $300,000, if you put it in this trust, your beneficiaries still get a step up in basis to the $300,000 date of death value, which is important. A gift outright gets a carryover basis, and there'd be much more tax, or there'd be tax due when it wouldn't be before. We can put stocks and bonds in here. We can put annuities in here. We put life insurance in here a lot. If you're not planning on cashing it, the cash value counts against you from a Medicaid perspective. And also something else that people don't consider is, generally speaking, the first beneficiary in life insurance is a spouse. If you and your spouse are similar in age, that person may be on Medicaid by the time that you pass away. If you leave them money outright, then we've got a problem. You can also put business interests in here and other real property you own outside the home.
So Aaron, we're contrasting the Medicaid Asset Protection Trust, which is one type of irrevocable trust,
correct,
with the revocable living trust. Probably 95% of our clients fall into one category or the other. They want to avoid probate. They want to have management of their assets, but they're not really concerned about Medicaid. Perhaps they have long-term care insurance,
right,
and they're not doing the Medicaid asset protection planning. A lot of clients today, because of the difficulty in getting long-term care insurance and the high cost of long-term care, are preparing trusts for Medicaid asset protection. And so these are the two prime examples. If you're doing a life insurance trust, obviously what goes in is life insurance. If we're doing a dynasty trust, we won't put all the assets in. We'll put enough assets in to lock in tax exemptions. I'll talk about that in a minute. But depending upon the motivation of the trust, tax planning, asset protection planning, that's what will determine which assets get retitled and go into the trust. But for these two, Aaron's given you a good rundown, and there are certain things you want to keep out.
Sure. So obviously, we don't want you to be destitute. At the end of the day, it's your money. So we try to come and talk to you, come to an agreement about what is a good amount of money to keep out. So obviously, the older you are, the more money we're going to encourage you to put in. But at the end of the day, if you want to keep out 100,000, 200,000, 50,000, that is up to you. So we're always going to need a bank account outside the trust anyway to receive your income. That sometimes trips people up, but we need that account that your income is going to go into, even if we're applying for Medicaid ASAP. And again, you're going to keep your retirement account, whether that's an IRA, 401k, thrift savings program, 403b, whatever that tax deferred retirement account is going to stay with you. You're going to receive the income, and under New York law, an IRA or 401k and periodic payment status is exempt for Medicaid purposes. So it really dovetails well from that perspective. In an irrevocable trust, you haven't given up all control. You can change your trustee at any time. You can also change your beneficiary at any time, which is really the bigger stick if someone goes off the reservation. And believe it or not, you can revoke an irrevocable trust when it's drafted correctly. So you really have a lot of power, even though, quote, it's an irrevocable trust.
And a lot of these decisions depend upon the family situation.
Absolutely.
And we have this conversation with our clients when they come in. Do you trust your children? You know, are you confident that the children are going to do the right things? Do you have children? A lot of people come in and
Correct.
they don't have kids. So who the next people? Brothers, sisters, nieces, nephews, friends, who are going to fill the roles of trustee and beneficiary? And that negotiation of how much do we keep outside the trust very much depends upon who the other players in the game are. Because one of the features that you mentioned, Aaron, principal can be paid to children or others. So even though it's an irrevocable trust, and even though you've parted ways with the assets, through third parties, you can get them back.
Absolutely. And you need $20,000 to buy or $30,000 to buy a new car. The trustee simply writes a check to one of the other lifetime beneficiaries, turns around and gives you that money back or buys the car, and you're on your way and you've done everything correctly. These are the kinds of things, though, that need to be done carefully. No principal direct to the grantor. So we encourage our clients that if they need to do this and they're not sure exactly how to do it, to give us a call to make sure that they do it correctly.
Yeah, pulling money out is important because we do a lot of Medicaid applications. And when you file a Medicaid application, you're going to be, if it's a nursing home application, you're going to be giving them 60 months of records. And they're going to audit all 60 months, including trust records. So you want to make sure the accounting is done properly, the taxes are filed properly, and that you're tracking all of that flow of funds in and out of the trust. And speaking of Medicaid, Aaron, we've got some changes going on today.
Absolutely. As of today, new home care rules have come into effect. We've known about these for a long time, but it's a big change. Starting today, there's a 30-month look back for home care applications. That's up from 0, so that's a pretty big increase. This is still being phased in. There's some rules that are just coming out or just will be coming out. What we know right now is that if you apply essentially in October, November, or December, that they will not apply a look back. But starting January 1st, there'll be a 90-day look back, which will increase essentially by a month every month thereafter until it's a full 30-month look back. So doing things correctly, transferring things when you're well and when you have time are critically important. This doesn't mean that we can't help somebody after these things have happened, but the law is not going to get better. And especially in light of the current economic climate, it's anticipated that there'll be more changes in this area, which will make it more difficult to access benefits.
So the reason we have these Medicaid cuts now, the last time we saw serious Medicaid changes, they were federal, and they came in 2005 as part of the DRA, Deficit Reduction Act of 2005. These are New York State changes. And these came about because in January, the governor announced a deficit of $6.2 billion. And one of the largest components of New York State's budget is Medicaid. So they looked at Medicaid and looked at ways to cut Medicaid, and the only place they could really do serious cuts short term was the home care program. And so they have now imposed these new limitations on Medicaid home care. And in a COVID crisis, you can see that these you're just going at cross paths here because people need to get care at home. They want to get care at home, but now you have a 30-month look-back period being phased in for Medicaid home care purposes. So for people contemplating that trust funding,
Absolutely.
this is now weighing towards more funding, putting more assets in, getting the clock started. So when we talk about trust funding, we are packing the trust now going forward with more assets, knowing that we can get them back out if we need to, but we want to get that clock running on all of the asset transfers. And if you've got a trust and you've only partially funded it, now's a good time to reconsider and think about maybe putting some more assets into that trust so that you can start that Medicaid clock ticking. The next budget, we're going to have a projected $14.5 billion deficit. So it went from 6.2 in 2020, projected to 14.5 billion in 2021. We are anticipating more cuts to the Medicaid program. And Aaron, there's one key when we're doing trust planning, whether it's tax planning, talk about that in a moment, or Medicaid planning, and that's grandfathering. It's kind of like The Graduate, you know, I have one word, plastics. Grandfathering. We want to get your trust done. You want to get the assets in because when they change the law, they will almost always treat your existing trust under old law. Every time they made a change
Absolutely.
in this area, they grandfather in existing trust. So something you need to be aware of, get the trust done, get the trust funded. And if you have it properly drafted, there's enough flexibility in there that you can navigate and change course down the road if you need to. So Aaron, the other rules go in January 1.
That's right. And so we've really kind of already let the cat out of the bag on these. But so again, transfers made after October 1st are subject to a 30-month look back, which will be phased in starting from October 1st. If you apply, though, in October, November, or December, which means you actually need services at that point in time, there will be no look back. So as Lou very well has pointed out, it's a good time to think about whether you need to put more assets into the trust at this point.
So thank you for joining us today. If you have any friends that you're talking to and they may need this kind of planning, please let them know what's coming and that the laws are changing. We'll be posting this webinar on our website so they can view it later if you have people that do want to do it. And you can always email us and we'll give you the email information at the end, but it's info@pirolaw.com. And we'd be happy to make this available to anyone that you think may benefit because this is news. These are things that are happening. We're going to talk now a little bit about taxation. For that, I want to bring David Wojcicki back on camera. Hello, David.
Hello, Aaron. Thanks for that. Appreciate it.
Dave, did you happen to watch the debate?
It was stellar. It was very stellar.
I'm not going to get too political here, but we have things going on at the state level. I just mentioned the deficit that's COVID related. The federal government has deficits that are also COVID related. So we're going to talk a little bit about anticipated tax changes. But David, just to get us started here, talk a little bit about how trust taxation and individual taxation interrelate and how they differ.
Well, the general concept of really any entity paying tax, obviously, is you pay tax on the income you earn, and you're going to be able to provide deductions for whatever is a qualified expense that helps you earn that income. The government says, hey, if you're going to spend money to try to make money, the theory is we'll allow you to deduct it against that. So it's similar tax systems as far as how you pay tax. The rates are much different. As we'll see, the rates on the trust side are compressed. And I agree on the state side, the federal deficit's not going to get any better. And I'm sure we're going to see some tax increases, probably either side, actually, who wins. Not that we got much information on Tuesday night, but it was entertaining nonetheless.
Was it? I don't know. I had an awful feeling in the pit of my stomach. But anyway, that's another
Yeah. So we'll start with the just general. So once you form a trust, it's a separate legal entity. So anytime you have a separate legal entity, the IRS is going to have rules related to how that entity is taxed and is going to be looking for a separate tax return. That happens in the realm of a trust when a trust is formed. If it's a revocable trust, really nothing has changed other than you have a new naming. As we talked about funding the trust, it'll be in the revocable trust name. Nothing's really changed there. You don't need a separate ID number. You can use your social security number, continue filing your tax returns that you have in the past. If it's an irrevocable trust, not all irrevocable trusts require a separate tax ID number. As a practical matter, there's reasons you probably should get one. It's just easier down the road, and it also separates, you can identify when there's funding issues because you'll realize you don't have assets that are in the ID number of the new trust that you just formed. So we recommend getting an ID number for the trust, and that creates then that separate legal entity, separate tax ID number, and then you follow the rules for whatever type of trust it happens to be. Generally, when we get to the types of trusts, generally between the attorney and the CPA, there's reasons as to how you set up the trust, as to how it's going to be taxed, and what type of trust it is. You also have the state tax issues. Every state has the rules as far as, hey, is this a trust of New York? Is this a trust of any state? But if it's a non-New York trust, it could be based on who the beneficiary is. It could be based on who the trustee is. It could be based on the situs of when it was transferred in, which is what New York follows. The three types of trusts basically is there's a grantor trust, a complex trust, and a simple trust. We'll see all that. And there's information for tax professionals, which is Lou's firm is so nice to provide, which gives a pretty good outline of how the trust works from a tax perspective. And if you don't have an experienced professional, it certainly is a good thing for them to follow. Even yourself, if you're going to try to become an accountant for the weekend, you can read up on that a little bit.
So, thank you, David. We've added a discussion of the estate tax. We hadn't done this up until now in our quarterly workshops, but it bears discussion right now because in 34 days, we're going to have an election, and these rules may in fact change. So right now, we have a federal estate tax exemption. It came in as part of the individual Trump tax cuts in 2018, and we have a federal gift tax exemption of $11,580,000. For federal purposes, the estate and gift tax systems are unified. So the gift tax and the estate tax are the same tax. You get the same exemption. If you use your exemption during lifetime, it's then not available for your estate. And if you're a New York resident, you'll see there, as most states, New York does not have any gift tax. So you can transfer unlimited amounts of assets in New York, and there is no gift tax return that even needs to be filed. And Dave, there is a federal gift tax return, and you prepare those, I believe.
Yeah, yep. Yeah, of course, there's certainly going to be probably changes in this area. Well, of course, if there's Democratic control, there will be for sure, but there's a lot of planning around, as you know, coming up around just as far as if it were to sunset in 2025, with utilize the gifting, the portability exemption. It goes hand in hand with the trust, with the gifting, everything you're probably advising your clients.
So let's talk about that sunset, because that is part of the current law. When the tax cuts for individuals were enacted, they were temporary cuts. Unlike the corporate cuts, which are permanent, the temporary cuts, individual income tax rates, capital gains, all of the other rules are only temporary, and they sunset December 31, 2025. At that point in time, this federal gift and estate tax exemption goes from 11.58 to $5 million. It goes back to where it was pre-2018, adjusted for inflation. So a lot of clients, and you're right, we have about 15 clients right now that we're working actively on who are utilizing that $11.58 million estate tax exemption, gift tax exemption, locking it in now, because the IRS has said they're not going to go backwards. They're not going to claw back against it when the tax rates come down. For New Yorkers, we have an estate tax. We don't have a gift tax, but we have an estate tax, and we have a catchy little rule that says if you gift assets within 3 years of death, they get put back, clawed back into your estate, and are then subject to estate taxation. And in New York, we have an exemption of $5,850,000. Still a very high number. For many years, it was 1 million, changed in 2014, phased in to what's now 5 million inflation adjusted, 5.85 in 2020. So when you die, as long as you don't have more than 5,850,000, you don't have any estate tax. For federal purposes, you don't have any if you're less than 11,580,000. And so gifting, now you can lock in that federal exemption plus avoid the New York State estate tax provided you live 3 years. So people are taking advantage of these rules. And David, because of these elevated exemptions, when I started my career, I give this number all the time, and I remember it for God knows why. $108,333. That was the New York State exemption equivalent. 108,333. Now it's $5,850,000. That tells you where tax law and tax policy have gone. Will we revert back? Federally, this guy is on the ballot. He may get elected if he gets a Democratic Senate, as you said. These are all the things, Dave, that he's talking about. And one of them is an estate tax exemption of $3.5 million, but there are also income tax changes proposed.
Yeah, I think the step up and the lowering of the estate tax has a lot of ramifications.
Yep. So you need to know that this is all in play, and that if you want to do planning, getting it done before the end of the year is key, because the legislation that's passed, even after January 20th, when the new president or the existing president gets sworn in, that legislation can be retroactive to January 1. And so we're anticipating that if it does get swept to Democrats, that we will have changes, potentially January 1 effective dates. So Dave, back to our trusts.
Okay, so we talked about the majority of probably the people who are in the audience are probably going to have what's called the grantor trust, and that is where the grantor of the trust is treated as the owner, and although there's a separate tax filing, it's basically to notify the IRS that says, hey, I've got this trust ID, this separate entity, but it's going to be taxed as a grantor trust. And there's a checkbox and a little note you tell the IRS and an attachment that shows them all the income or expenses that are inside that grantor trust, but it's going to end up in the same exact place that it did when you filed your individual return. So if you had just dividends of $100 and it was always on your individual return, you'd have a grantor trust filing that would show the $100 and it would end up in the same place, look the same as it did before you had the grantor trust. It's as if nothing happened from a tax perspective. It's almost an ignored entity for tax purposes. And there's usually reasons why you would do that. And between the CPA and the attorney, they would come up as to things you can actually put in the trust document to make sure it is a grantor trust. Lou? Simple trust. So we talked about there's three types of trust: the grantor trust, the simple trust, and there's a complex trust. The simple trust is a trust document that tells the trustee you are required to distribute all income to the beneficiaries, at least annually. Often it's quarterly, but at least annually. Trustee doesn't have discretion, doesn't have to decide whether you need the money. The trustee just has the edict to figure out what the income is to the trust, pay it out to the beneficiary, and then the beneficiary will pay the tax on the income they received. However, the concept of capital gains is not considered income for, in most cases, income for simple trust and fiduciary purposes. So for example, if you owned 100 shares of IBM and the dividend paid was $50, that's considered income because the capital or the principal of the trust would be the shares of IBM. The income would be the dividend that would be distributed out to the beneficiary. If in the same year after the dividend you sold the stock and the stock had a gain, that would actually be taxable to the trust. It's not considered income because it's just a different format. You've taken the principal of the stock of IBM and reinvested it into something else, or just kept it in cash, but it's considered to be principal and doesn't get distributed out. You have to be careful in that because the tax rates, as we'll see in the trust realm, are much higher than they are individually, and therefore the trust itself will end up paying some tax in a simple trust scenario. Complex trust is essentially anything that's really, for the most part, not a grantor trust or a simple trust, and it's a discretionary trust such that the trustee will have the ability to decide what is distributed to the beneficiaries. They could distribute all the income, some of the income, none of the income. You can distribute out capital gains if it's in the trust document or you have a consistent practice or a methodology of what you're distributing. This is really where complex trust is really where there's some large planning opportunities just because of the difference in tax rates. If you think of most design and most trusts, you generally will have a wealthier individual, parent, grandparent, setting up the trust. And the recipients, the beneficiaries, probably the kids or the grandkids, most likely in a lower tax bracket. And so if you were to distribute out the income, it's going to go to a low tax bracket beneficiary as opposed to remaining in the trust and being taxed at a high rate. And you have the ability to actually have a little bit of hindsight in this case, which is somewhat unusual for tax planning, to decide, does it make sense for me to distribute out the money to certain beneficiaries, or does it make sense for the trust to maintain the money and pay the tax? And we'll see how that works in a couple minutes.
Okay, we have a poll, Dave. Take it away.
Excellent. All right, individual taxpayer pays federal income tax at 37%, which is currently the highest rate, likely to go up. A non-grantor trust pays the maximum rate of 37% once income is over what? So what is the highest rate for a trust versus the highest rate in an individual? When an individual is over 518, what is it for a trust? Give a couple of minutes. Cool.
This is a little bit more of a technical question, so see what you can do. Let's everybody participate in this one. What do you think?
25%.
Where does the trust begin to pay that 37% income tax? An individual is $518,400.
So what do we have? We have 300,000, 38%, 21% at the 162. 38% of these were right. It's the 12,750. So what that means is if you had, let's say, $15,000 of interest and dividends inside the trust, part of that income above the 12,750 would be taxed at 38%. If it was distributed out, the income tax would be paid on the beneficiary's income tax rate, which if it's, you know, a younger generation beneficiary, it's probably in the 10 to 15% realm. So you're saving 28% on the difference in tax rates. Here's the tax brackets. You can see they scale from 10%, 10, 24, 35, and 37. It doesn't take much so you're paying 37%. In addition to the 37%, if it happens to be investment income, which is your dividends, capital gains, there's another 3.8 net investment income tax surcharge, and then you have the state rate on top of that as well. So your state rate, depending on your income, is somewhere in the 6.5 to, can be as high as 8.82. So if you add those numbers up, it's 47, 46, 47, 48% of income. So there's really, tax planning is important when it comes to a complex trust.
We have a word for that, Dave. It's confiscatory. When it comes to trust income taxation, this is really a confiscatory tax. It's taking a lot of that income.
Word. I'll have to add that to my vocabulary.
There you go.
This is like a law word. Okay, so definition of income we talked about briefly. From a fiduciary standpoint, it's a little bit of a different definition. And if you think about the way you fund a trust, you're funding a trust with something, whether it's a house, whether it's cash, whether it's stock. That's all considered a principal. It's what you put into the trust, which is used to produce income. So if you have IBM stock, that's going to produce income. If you sell the IBM stock because you want to buy Apple, that if there was a gain, it's not considered income because you've just taken the form of that IBM stock and moved it into the form of Apple, and it becomes principal. It's important in the realm of the trustee because the trustee needs to make sure they're following the requirements of the trust if they're required to distribute out income and what the definition of income is. Principal, we talked about that a minute ago. Principal is what you've received. It can exchange the type of principal you have. It generally will. You usually don't sit on just cash or just one type of investment. You're reinvesting it. But the reason it's important, if you think about most trusts, the way they're set up is maybe a parent or a grandparent sets up a trust. Generally, they have the income interest or what's happening currently going to a spouse, perhaps a child. But they want the remainder when that person's no longer around to go to a grandchild or perhaps a child, depending on how it's set up. So it's important to really be able to tell, hey, what am I having? What do I want my remainder men to actually be left with? And what should they be left with? You don't want them down the road to come back and say, you know, you squandered a lot of the money that would have went to us because you distributed more than you were allowed to distribute in the trust document. So it is an important concept for the trustees to make sure they understand. Tax brackets and investment tax. So this is there's a rule in the trust area called the 65-day rule. And really the practical reason behind that is if I'm a trustee and I don't really know what my income is to distribute until the year is done, until December 31st. I'd have to sit there and wait till the markets close or make sure I could post everything to that day in order to do an exact calculation. And because it's considered to be a distribution out to the beneficiary and impacts taxes, it wouldn't really be a fair rule to make you try to guess where you're going to end up. So basically there's a rule that allows you to make a distribution anytime in the first 65 days, which would be March 6th, except for leap year. And that will allow you to distribute the income that you calculated prior to December 31st, and you can push the taxes out at that point. So essentially, you're going to know where you stand. You're probably going to have an idea where your beneficiary's income is, and you have 65 days to figure out what the optimum amount of income to distribute out to the beneficiaries would be. So it's a nice rule to take advantage of. I know we take advantage of it all the time, and I'm sure Lou encourages the clients to do that as well. It doesn't take a lot. When you have a 20% spread in tax rates, it doesn't take a lot to make a difference.
So it's very important to know what type of trust you have from a tax perspective. So that's why we give that memorandum to your tax professional when we do the trust. With grantor trusts, it's a very simple return. Dave's going to talk about that in a bit. But with complex trusts, this management is absolutely key. And at the end of the year, a lot of people last year didn't get their 1099s on time because of COVID. But you get your 1099s, you measure the income that the trust has, you look at the trust tax brackets, you look at the beneficiaries' tax brackets, and very often we put what are called sprinkle provisions in, where you can bracket shop. You can distribute income to the beneficiaries in the lowest income tax brackets, and they can then have it taxed at their own income tax rate. So this planning in the beginning of the following year is critical. You need to work with your tax professional, look at each individual's tax brackets, and manage that trust income appropriately.
Yeah, we had a situation last year. I mean, part of it is also talking to the trustee, who also needs to decide whether the cash should be distributed out. But I think we saved 20,000 plus last year, and you can pretty much, encourage the trustee, assuming that you're somewhat responsible beneficiaries, that it's a no-brainer to distribute out the money when it's a significant tax savings.
Absolutely. So we're going to move to lifetime administration. I'm going to turn it over to Aaron to talk about, from a legal perspective, what the considerations are for those of you who are trustees during lifetime in the administration of the trust. Aaron?
Sure. So with a revocable trust, generally speaking, the grantor, again, the person who establishes the trust, is the trustee and is also the beneficiary. So again, you being you. Now, this does not mean that the grantor of a revocable trust has to be the trustee. We have certain situations where mom or dad or whomever has just decided that they don't want to manage their assets anymore and appoint somebody to do that for them. That can still be done. Generally, though, most often, revocable trust, the trustee triggers off either at death, meaning the revocable trust becomes irrevocable, or during incapacity. If you have a well-drafted revocable trust, you're going to name a successor right there. And it's going to be easy for them to get appointed. How do we determine incapacity? Generally, a doctor has signed off and said that the person is incapacitated. It can be determined by a court, although one of the main reasons to do a revocable trust is to try to stay out of that court process. But if there's a dispute, it can be resolved there. And disappearance, we don't see this a lot, but after a certain period of time, you are deemed to have disappeared, and that goes under the incapacity definition. What does a trustee of your trust do during your incapacity? They manage the assets for your benefit. They're your fiduciary, which means they have to act in your best interests. Okay, you're going to leave some instructions in the trust about how to handle things, to continue any gifting program you may have, or to take care of your spouse, all of those things. It's going to say how to administer your dependents. And certainly if you have a special needs beneficiary, or you have a beneficiary who needs assistance in controlling their spending, a spendthrift, that is going to be set out there as well. In an irrevocable trust, you're not the trustee at the beginning anyway, generally speaking. Okay, you're still going to receive the income, because in an irrevocable trust, you're entitled to all income. If a house needs to be sold because you're going to a facility, your trustee is going to do that. The principal is going to remain in the trust. If there's a reason to put principal out to the remainder beneficiaries, the trustee can do that. But generally speaking, we're going to hold that money there until you've passed away.
And Aaron, in certain cases, just aren't individuals to take that role
Correct.
of trustee or successor trustee. And if you don't have individuals, or you think the individuals may need assistance in administering a trust, we very often name a corporate fiduciary, a trust company, a financial institution with experience in managing trusts. And again, we're very happy to have our sponsor for today's program also be a participant in today's program as a corporate fiduciary. And Michael and John, TRUSTCO provides a number of services. Why don't you tell us and our audience a little bit about that?
I'd like to introduce myself. I'm Michael Bates. I'm the Business Development Officer for TRUSTCO Bank. My job is to work with the clients of the bank as well as anybody else. We do get referrals from attorneys and CPAs up and down the thruway here. And we handle a lot of clients, and those clients can be here in the Capital District. They can be New York State. They can be in any state, to tell you the truth, and we have clients all over the place. I'd like to introduce John Brissonis.
Hi, my name is John Brissonis. I'm a senior officer here at TRUSTCO. I've been in the department for 13 years. I oversee the trust and estate administration within our department, and also have handled some of the retirement plans. Very happy to be here with you today.
Okay, thank you, John. Appreciate that very much. And as I said earlier, quite frankly, we know a good thing. And what I want to start with is to let you know that you have some handouts on the system to look at us a little bit more detail. And what you'll find is you'll find that we have a menu of really 3 things that we stand out to do, and that is the estate administration, trust administration, and investment management. So you're going to have your trust drafted by an attorney, but something happens that you should not be able to take on if your trustee is not able to take on the duties. Perhaps they cannot fulfill the role as executor or trustee, maybe because it's A, too complex, or B, it creates family conflict. Maybe it's just a simply wiser thing to do to leave it up to a professional service, or as was said earlier in this webinar, that you may be concerned about theft. So having a corporate fiduciary, a corporate trustee to take over, you're basically putting in the hands of experienced people who know what to do. And of course, we'll work with your CPAs and attorneys on managing the money and managing the trust for the beneficiaries. So we'll get a little bit into the menu. John was going to say a little bit about estate and trust administration.
Sure. And so in terms of TRUSTCO Bank, like Mike said, our 3 core services are estates, trust administration, and investment management. In terms of the estate administration, we serve as executor, co-executor, typically with a family member or spouse. And we also can serve as an agent for an individual and executor, usually in a case where they would need to open up a estate investment account to perhaps hold stocks or bonds until those securities are transferred out in accordance with their will. We work in tandem with the attorneys and accountants, the drafting attorneys. We feel that continuity is very important. We also will work with accountants and attorneys in filing all the necessary tax returns for the estate and the final tax returns for the decedent. And we provide a high quality of customer service. We're here in the office on a daily basis, and we're reachable. In terms of the trust administration, very similar role. We'll serve as an individual trustee, a co-trustee, again, typically with a family member, and we could also manage the assets of a trust for an individual trustee that may not have the expertise to manage those assets on their own. We're held to the Prudent Investor Act, so we have an obligation to provide a level of income to the current beneficiary of the trust, as well as try to and grow the trust for the remainder beneficiary interests. As a trust department in a bank, we're always looking to get in front of our clients and have meetings on a regular basis to discuss their needs and planning in the future. And last note, in terms of investment management, I think, Mike, you wanted to discuss
Sure.
that?
In terms of investment management, while you're either alive or once you pass and we're managing money, we have we can manage qualified and non-qualified accounts. A qualified account will be like your IRAs. Non-qualified would be your liquid money. We'll customize an investment portfolio if you're alive, based on your risk tolerance and your time horizon for the money. Beyond for your beneficiaries, we would take we would follow the Prudent Investor Act as far as setting up how we would manage that money or what the investment mix would be between income and equities, fixed income and equities. We do offer a bill paying service for folks that, you know, alive, let's say that, you know, you just don't want to pay your bills anymore. Perhaps you have arthritis in your hands and you need someone to help. Certainly, if you have an account with us here, we'll certainly help you out with bill paying. That's a very important service. I think, Lou, you one time mentioned to me that that was a great service to offer, that not many people offer that service. So investment management, we do a good job. There is a performance sheet in your downloads. It shows you what our performance has been the last quarter, the last year, 3, 5, 7, and 10 years out. We hit our benchmarks just like any firm on Wall Street would. We do a very, very good job at managing the money. There are a couple of people on the account at all times, an administrator that helps the investment manager, investment manager might be on the account, on the computer all day long managing money, and the administrator would help you and help the investment officer to make sure there's continuity and also servicing your needs. So as investment managers, we do a very good job. We work closely with you, and as John said, there will be reviews and meetings. So we would encourage you to give us a call. There's really not much else to say from this end. Please ask us for a service if you need service. And I thank you very, very much for giving us the opportunity to talk to you today.
Michael and John, thank you so much for that information. So when we're designing plans, very often we'll sit around the table and the question will come up, okay, so what do my trustees have to do? Well, they have to manage assets. Do I have someone that they would work with? If you do, great. If you don't, there are investment management services, but the role of co-trustee and successor trustee, who's going to be there when all the individuals are gone or you don't have the appropriate individuals? We use corporate fiduciaries in our planning on a very frequent basis, and it's a very important role to keep in mind. There is a solution. You can get a professional trustee to work on the trust, and as Mike said, there's more material in the handouts. I want to bring Dave back on now. And we're going to talk about the nitty-gritty of the tax returns. And Dave, going through calculating tax liability and filing the returns, what is a trustee to do?
Well, is there anything more fun than preparing a tax return, really? So anyway, the trustee's responsibility is to obviously file the return on behalf of the trust. And again, we go back to concept of, everybody kind of knows what income is and what's taxable and expects to pay tax. The deduction concept in a trust scenario is a little bit different than it is individually. But again, if you can relate the deductions that you're incurring on behalf of the trust to either the fact that you're incurring them because you have a trust entity or because you're hoping to produce more income, they're generally deductible. The one big concept that's different in trust than your individual tax return is the concept of a deduction for distributions. So normally your income tax return individually, you have income, you have expenses, you pay tax on what's left, you have some personal exemptions and some itemized deductions. But on the trust side, it's income less deductions, but you also get a deduction for what's distributed out to the beneficiaries, which is kind of a weird concept because it's not really an expense. It's just moving money from the trust to someone else. But what it really is doing is it's shifting the tax obligation from inside the trust to the beneficiary who's going to pick up the tax. So the IRS is still going to get their money. They're just going to get it from a different source. So we'll walk through how it calculates. Again, on the income side, if you think of it from individual, you're always going to pay tax on your earnings, your rental real estate, business income, your pass-through income. And on the deduction side, these are a little bit different, especially since the Tax Cuts and Jobs Act was placed in service, because the miscellaneous itemized deduction category, which is where your legal and accounting fees were, which is where a lot of your any deductions related to producing some income, it was eliminated under that tax act. And so a lot of those deductions you got individually, you no longer are getting. It does follow that through to the trust side, but only to the extent that those are expenses that you would have incurred anyway, whether you're in a trust environment are not, and most expenses are not. So generally your accounting fees, your legal fees related to the trust, your fiduciary fees related to the trustee, for example, they're all deductible, whereas they may be lost on the individual side. The taxes, if you think about taxes, everybody in New York at least has been limited on their property taxes and state income taxes to $10,000. If the same issues on the trust side, you're going to be limited on the tax deduction to 10 grand. Administration expenses are those expenses for administering the trust that you're incurring because you're operating a trust entity. Those are deductible in the trust setting. So that's kind of the differences between the individual side and the fiduciary returns. We'll run through relatively quickly because don't want to bore you with the details, but at least you should understand the concept of filling out the returns. The grantor trust returns, most people can probably prepare them by themselves, or at least maybe after the first year a professional does, you might be able to follow it and do it. You can see on the screen the various trusts that you need to decide. And we talked about the 3 types of trust. You'll see the second box down is a simple trust, third box down is a complex trust, and then skip a couple more as the grantor type trust. Those are the 3 boxes essentially. You'll be checking one of those boxes based on the type of trust you have, and that starts your process for the preparation part of the return. So we talked about before, a grantor trust, nothing has happened. It's a separate legal entity, is a separate ID number. Up in the box C that you'll put the ID number, you'll fill out the name of the trust. But again, the IRS essentially ignores it. It says, tell us that you have a trust, check the box that it's a grantor trust. Then we know that there's going to be this attached letter that goes to the grantor, and we're not looking for anything else on this grantor trust return. We're going to go here, find the income so that we can match it to the 1099, and then we expect to see it on the 1040. Just like we would have saw that income on your individual tax return before you formed the trust and had grantor trust status. You'll see down below on this grantor letter, even the mortgage interest and property taxes, which would be your real estate taxes, that's likely the personal residence of the grantor in this grantor trust, and it'll end up on Schedule A just like it would if you were doing your individual tax return. Now we go to a simple trust. A simple trust, we talked about the trustee has a obligation to make sure they distribute out the definition of income to the beneficiaries. And this is a relatively simple trust. It's got some interest income, $750. It has some ordinary dividends for a total income on line 9 of $33,500. It has some deductions. It has an interest deduction, could have been anything related to whatever this trust has inside it, and then taxes of $7,500 for a deduction of $12,000. And that leaves you with $21,500 in what we would think of net income. This trustee then has said, I have to distribute this $21,500 out to the beneficiaries I'm supposed to distribute it out to, and you get a deduction, and that's the circled number, 21.5. And essentially that has zeroed out all the income in the trust. So this simple trust won't pay any tax. The 21.5 we'll see on the next screen, I believe. So 21.5, so this is a Schedule K1, it's called. It goes to the beneficiary. The beneficiary receives this form, and they know that they're going to pick up $21,500 and plop it on their individual tax return. And again, it shifted the income from being taxed in the trust return fiduciary setting onto the individual tax return. But it is a separate tax filing, and the details are a little different on the simple trust as opposed to what the grantor trust did. And then, go ahead, Lou.
Thanks, David. Management of the grantor trust is very simple. The grantor trust letter gets filed every year. Again, complex trusts, simple trusts. We don't see a lot of simple trusts.
No.
Usually what we're seeing is either a grantor trust or a complex trust. Those are the 2 most common. And we're going to talk about different types of trusts, like a beneficiary control trust that is a complex trust. So again, it takes active management. You're not just managing the investments, because that's part of the fiduciary duty. They talked about, Mike and John talked about the prudent investor rule. So you have to know what the proper investments are, but you're also managing the tax consequences of the trust. And that's part of your duties as a trustee, to make sure that you are looking at these tax consequences and year over year, working with someone like Dave's firm to make sure that you are mitigating and minimizing the trust income tax. Because remember that $12,750 number, this is where the income goes out. It's called DNI, distributable net income. It goes to the beneficiary and gets reported on the K1. Dave, any last words on the trust tax filings?
No, I would just say on this, if you take this example, if the income was 21,500 not distributed, because the graduated rates are blended, if it was in the trust setting, it probably would have taxes 6,200 bucks, let's say. If it was distributed out to the individual, I'd say most individuals would probably pay in this setting, maybe 3,000, 3,500. So even a low income amount, relatively low income amount, it would be very easy to save $3,000 without a lot of effort in planning, other than some communication between the trustee, likely the advisor and the CPA.
Excellent. Thank you, David.
Thank you.
So at this point, Aaron, I think if Sinatra would be appropriate. You know, this is the end. I've done it my way, but at death, the trust takes on a whole new connotation, and there are other things that have to happen. So let's talk about trust administration, paying bills, costs, and all the other things that go along with it.
Sure. So hopefully you've done a trust, and we're going to avoid probate altogether. As Lou said, there's sometimes hanging things out there: tax refunds, facility refunds, income you receive in the month that you died may not be in your trust. So we may end up in court. We want to avoid this as much as possible. It's a very long and costly process, and we want to make sure that you're funded and you fund up as much of this as you can. The good news is if it's under $50,000, it's what's called a small probate. Even better if it's under 15, it can be handled pretty easily. But again, we want to avoid this process altogether as much as possible.
And you might think, we're lawyers, right? We make money. Where do we make the most money, Aaron?
On probate.
In court. That's what we have a monopoly on. And we're the only ones that can go to court and represent people other than yourself. So why are we talking people out of probate? Because it's not in their best interest. And we've had this debate in the bar for a very long time. New York is one of the last states in the country to come on board with trust planning. Most attorneys would put the will in their safe and wait for clients to pass, and that was their retirement, and they would charge 5% as an attorney's fee. It used to be very common, a flat 5% across the estate. That's not the norm anymore.
No, it's not.
But nonetheless, probate is very expensive, it's time consuming, and if you can avoid it, here's why.
Well, here are all the, maybe not even all, but a lot of the issues that can come up. Incapacitated distributees or minor beneficiaries means that a lawyer is appointed to safeguard their interests, which means more money is going to come out of your estate and more time is going to be spent. Sometimes we have difficulty tracking down who the beneficiaries actually are, and we have to employ genealogists. That's costly, time consuming. Certainly, if you have an heir or a potential heir who you've cut out, or someone who thinks they're not getting what they should get, then you end up in a will contest, which probate is built for, because the court essentially asks everyone to sign off and say this is your last will and testament, which does not happen if you use a trust. So there are a lot of delays and pitfalls possible with the probate administration, and they all drive the cost and the time for distribution up. So those are not good things. The next slide really goes through all the ways that fees can accumulate. All right, court fees are honestly on the lower end of all of this. Heir search is very expensive. Your trustee can take a commission, but you may negotiate otherwise. Almost always in an estate where people don't like each other, they're going to take a commission. Legal fees are going to go way up. Service of process is not required with a trust. Bond is not generally required with a trust. You could make your trustee bond, but it'd be unusual. And all of these fees are going to go up and up and up if you're in the probate world. The next slide is contrasted with a trust. All right, no probate, meaning you're not going to court. You can get access essentially right away. And it's important to a lot of people that their assets, their scheme, who their beneficiaries are, remain private. And that does not happen when you use a will. Certainly, it becomes, if you're famous or there's some kind of scandal with your estate, it'll be in the New York Post or some other paper, and we'll know who your beneficiaries are. Certainly, I have clients who want to leave money to some person or another that they prefer that other people don't know about. So the privacy is also a big part of it.
So as we mentioned earlier, clients come in all the time and they call our radio show. We have a radio show every Saturday called Life Happens, 11 a.m. on WGY. There's a plug. But they come in and say, I have a will. I don't have to go to probate, right? Wrong. When you have a will, the definition of probate is the proving of the will. The will has no validity. If you took your will, you went to a bank and you handed it to a teller, say, here's my name, I'm the executor, here's my name, I'm the beneficiary, I want to get that bank account. Do they get it?
They do not.
No, you've got to go through the probate process and get a certificate called letters testamentary from the judge, an order. That's part of the delay. So when we're doing planning and we're doing trust planning and you're doing trust administration, part of the reason the trust is much more expensive up front is that we have to plan for all of these things that are otherwise done through the court process, through the probate process. So you're creating a private administration, and we're going to talk in a minute about that administration lasting not just your lifetime, your children's lifetime, but your grandchildren's lifetime as well. So you can avoid this court process in 3 generations with a very simple planning technique that we're going to go over in just a minute. And Aaron, I couldn't help thinking about a case that we're working on as you're talking about this. It's a client that I was very close to. I did work for him for several years. He had a very nice estate, and he had a couple of assets that got left out of probate. So we had to probate a will. He has 3 children, 2 sons who he was very close to, a daughter who was alienated from the family and hadn't been part of their lives for over 10 years. Well, what happens? We probate the will, and who shows up? The daughter. The daughter. And files objections. Now we're going through an extensive discovery proceeding. The legal fees in that case are going to be as much as the value passing through probate. But it's because it was in a will. There's a vast fortune that went through trusts that the 2 sons are enjoying and having a very easy time with. That's why the planning is so important. You need a will, but you want to avoid probate at all costs. In this case, there were after acquired assets we didn't know about. They ended up in the probate estate, and so we're dealing with that. But you want to make sure, this is why your trust needs to be fully funded, and you need to consider all of the things about administration and making sure that it's done properly year to year. Distributions to beneficiaries. So when it comes time to choose the beneficiaries in your plan, whether it's a will or a trust, you can have your spouse as a beneficiary, you can have a joint revocable trust or a joint irrevocable trust, and that trust simply continues on for 2 lifetimes. If you're over that $5,850,000 and you need to do tax planning in New York State, if you're in Massachusetts, you got to know that it's a $1 million estate tax exemption, so it's much more important to do the tax planning. But you need to do this, and you can do it through your trust, and you can double that exemption through proper trust planning using things like disclaimers and qualified terminable interest property trusts, and we can double that exemption to over $11 million. So good planning can be done through the trust, again, without the necessity of probate. On the second death, are we now distributing outright to the beneficiaries, or do we want to look, Aaron, at protecting the assets for them? And in this case, we have a very special trust that's become extremely popular, so popular, I did it myself for my kids. And it's something where you can leave assets in trust. I happen to have 3 children, they're all grown, so each one gets a trust. If my wife and I are both gone, my children get a trust that they are their own trustee of. They can manage it. They can run the trust any way they want to, but if they get divorced later, everything that I've worked for doesn't go into a matrimonial action. If they get sued, if they go bankrupt, if they get ill and need Medicaid, that trust protects the assets for them, even though they're their own trustee for their lifetime. So this type of trust planning, when my trust ends and my wife's trust ends, our trust, then it's going to go on to our kids, and there's the beneficiary control trust. Child is trustee, child is beneficiary. They use it for themselves, they use it for their family. If something happens and I have a child past then who doesn't have their own kids, it goes back to my other 2 kids. So we can put it in, and we call it a bloodline trust. Keep it in my bloodline. And most parents really are attracted to this. If you have kids, this is something you're going to want to think about. These trusts, however, once I die, are complex trusts. So my kids need to work with someone like Dave to manage the tax consequences and minimize the income tax on those. So Dave, you want to come back? What's the timing on these returns, and how do you choose when to file?
Well, you have requirements. So the 1040, obviously, if someone passes away, you have a final 1040, although it is not required to file a final return if you don't meet the income threshold. So if someone were to pass away January 20th, they likely wouldn't meet the income requirements to file a return. And there's no requirements that you file a return and notify the IRS that, hey, I deceased, and you wouldn't, of course, but the executor. But you do have a final 1040. There's an estate 1041 if you have, again, there's an income threshold that you would have to file at the estate itself if you didn't have everything in trust. And there was some items that were left in the decedent's name. You would have to file the trust year would start on the date of death, and it would go, or the estate fiduciary return would start on day of death. It would go a year from there, although you can choose when to kind of cut it off, and there's tax reasons as to what to make your year end, when to include expenses. There's a lot of, it says on the screen, there's a lot of timing issues related to the estate and trust. There's expenses you're going to incur just relating to processing thing. You may not have the probate expenses, but you're going to have some expenses just finalizing the trust returns. And when you actually report those does have some timing impact, because you can decide whether, again, those deductions are going to be passed out to the beneficiaries or stay within the trust or the estate. We talked earlier about the 706. Most of us probably are not going to have a taxable estate. However, on the federal side, there's a concept called portability, which means you can double the amount of estate assets you can pass away with. But you can't do that unless you file an estate, a 706, a Form 706, which is a estate return. And that tells the IRS, hey, I don't have a taxable estate, but this is how much my assets were. And I want to leave whatever exemption I have left to my spouse to utilize. So in theory, you can have 22 million between the two of you on the federal side. We generally encourage filing those if there's a chance, even a chance that there's going to be a taxable estate, especially given the political climate right now, given that likely there's going to be a political sunset in 2025, or even a change in politics, and we will have a reduction in the exemption. Trust 1041, they will continue on until they're dissolved, if they're dissolved. If not, the 1041, which is what we were talking about before, that's the trust form number, will continue filing.
And what about accounting requirements? A lot of people are concerned that they have to file formal accountings. That's very rare. But
Very rare.
what are the accounting requirements?
Well, generally, we waive them in our trust. That does not mean they can't be required if the beneficiary goes to court to demand an accounting of a trust or an estate. Generally, you want to try to avoid this because they're complicated, certainly a formal accounting. We usually need to involve someone like Dave to get them done.
100% agree.
If you have a charitable beneficiary that's getting part of the remainder of the trust, that will pull in a formal accounting requirement. So you have to be careful how you phrase charitable bequests and how you make them. And just know that if you are going to make charities a big part of your estate and part of the residue, that you will need to file, and the Attorney General will be reviewing that particular accounting. That's a tough one. So how do you maintain a trust? How do you maintain a plan? Once it's up and running, to make sure that it gets funded properly, that it's continually funded? We have installed in our practice, and we've been doing this for almost 20 years now, a lifetime maintenance system. We call it our PALMS program. We're in the midst of multiple law changes. We mentioned the state deficit. The federal deficit this year is going to be somewhere between $3 and $5 trillion. The national debt is 23 trillion, soaring to 25 to 28 trillion. So sooner or later, those are going to really ripple through the laws, taxation, Medicaid, Medicare, all those things. So you want to make sure you're keeping your program and your trust current. That's what our annual maintenance program does. We track all of your assets. We map them in a software program that's fully encrypted. We meet with you on an annual basis. You have access to that, plus all of your documents in that encrypted storage facility. We then go through everything with you on an annual basis and make sure that your plan is kept up to date, so that something does happen, you don't have dangling assets, you don't have open issues, you've got your trust buttoned up, and we try to make sure that that happens on an annual basis. We're going to take some questions. We got some great questions, so if you want to stay with us, we're going to take a few of those questions live, but I want to get a final poll here before we break. And if you would like to have a free consultation with myself, Aaron, or Dave, or with TRUSTCO, with Mike and John, please let us know. I want to thank all of our panelists, Michael, John, Dave, Aaron, and thank you all for joining us. Again, this is our quarterly workshop. We'll be back again. January 14th will be our next. Always go to our website to get additional webinars. We have them on a lot of topics, including the recent Medicaid changes, the upcoming Medicaid changes, the Secure Act, and you can always visit those at purelaw.com at the